Great. So I termed this workshop today as the madness of markets, because I feel like and you will understand this slowly through the other 7 workshops, that markets are irrational, and there's definitely madness, and there's definitely things moving across all the time, and that's why I termed this the madness of markets. But before we start today, I wanted to share a very, very personal story with all of you, and and
Certainly.
and, and start off, just to remind again, if everyone could go on mute, that would be really, really appreciated. Uh, but yes, coming back to the story, I want to share with all of you today here today is, so starting when I was 13 years old. I think yeah, after my 12th birthday. Yeah, that's way long. I think 16 years back, right? My dad on every birthday asked me to make a basket of stocks, and he would say that I would not give you anything on your birthday apart from the basket of stocks that you choose. So every birthday, from my 13th one, I used to, like, ask people, like ask my grandfather, ask my uncle, like, hey, do you know which stock I should get? So he used to tell me that it depends. So the amount that you'd get for your birthday would depend on what kind of stocks you choose, right? Because uh, say, for example, if I chose stocks worth $100, they wouldn't stay $100, right? They would grow in value over time, right? So he used to tell me, it's up to you. You got to choose, and you've got to stay with that decision. So I used to choose a basket of stocks every year for my 13th birthday, and he used to buy those for me in my name and keep it. And I never understood why he did that. I always thought dad could have given me a Lego. He could have given me anything. Why does he do that? Like, I can't show my friends what I'm getting. I can't do anything with it. I don't even know where it's going. I had no clue of brokers. I had no clue of where those stocks are being held. I had absolutely nothing to do with them. And I used to always ask myself, when will this stop? When will I get something decent, something which I can show around, something which I can be very proud of? It was only in 2022, when I was coming to Wharton for my MBA, that I really, really understood, that I really, really figured out why he did that when I paid almost close to 25 to 30% of the fees through what I held in those stocks. That's when I recognized that what he did was monumental for me, right? And that's why you need to know about markets. That's why you need to know about investments, because what you'd invest now might not be as crazy, might not be game changing for you right now, but those will be game changing for you 10 years down the line, 12 years down the line, 20 years down the line. And that's going to be, monumental in your life. So let's start with the very first uh, understanding of what is investing, as to, like, why is it important to invest? Why, and why should you do it, right? So investing money is not only about, your financial flexibility for the future. It's not only about gaining a lot of money, say 10 years down the line, but it's also about getting the corpus that you need at different points of your life to sustain you. So the act of investing is important because throughout your life, over the next 50, 60, 70 years of your lives, you will need monumental amount of sums of money to make you comfortable. Uh, and that's why you need to start investing as early as possible. As we can see in the slide, there are like a tale of two investors, one starting at the age of 20 and one starting at the age of 30. They made the same initial investments over the period of time, but at the end, they had very different amounts of money. I don't need to really explain it to you that Tanya would have a really much more comfortable life than Nikki, right? And the earlier you start investing, the easier it will be for you to establish the corpus that you need to be comfortable in your life. And that's what you want to do, right? You want to be comfortable in your life at every point in your life, right? So now that we know about what is investing and why we need to invest, let's think about how does this work? Like, why should I keep money in my account, and or why should I invest my money in the different instruments that there are, and and out of the blue in the next 10 years get a huge sum of money? How does that happen? Like, and that's why we call this the beauty of the time value of money. So incidentally, when you when most of you guys go to college and you take an elementary finance class, the first slide, the first thing that the professor is going to tell you, even at your master's level, not only at your undergraduate level, is the time value of money. Money starts compounding itself. So that's what we don't need to learn about, compounding value of money. So when you have, say, $100 in your account, and say, given the Fed rate right now in the US, and your rates in your country, more or less, they start compounding, right? So if I have $100 today, and given the 5% interest rates that the Fed in the US has, next year I would have $105 because I got interest on my money. So now when I'm keeping this money, what the banks are doing, or say companies are doing, is they're investing your money into something else, into something which is gonna give them money back. And when they get that money back, they are giving a certain percentage of that back to you. And that's how you get $105 for a $100 investment in the first year. Now, when the second year happens, you don't go back to the $100. You start from the $105 that you had at the end of the first year. So now in the second year, you have $110.2. And that's the beauty of compounding, because you do not start from where you were. You do not start from ground zero. You start from ground zero once, but then when you're in ground one, the next jump will come from ground one. So you don't get back to ground zero. And that's the beauty of compounding. That's the secret sauce of long-term wealth creation. We'll all see here that compounding will have a profound impact on long-term wealth creation. Even if you have like very small amounts of money and you invest it regularly, or you put it in a bank, in a savings account, at the end of the day, you will have a huge sum of money, which is going to help you through your life. So let's come back to investing. I'm sure most of you guys are here to learn more about investing. And so I was thinking about what are the asset classes that you have that you can invest in, and of course in your gym and all the games that you're playing. What are the different asset classes that you have? So you can definitely invest in stocks, which basically doesn't mean anything but an ownership in a company. So what a company does is they say that I'm going to distribute my wealth among the people because I'm going to use the people's money to build the company. And that's why you give them your money to build that company, and you get a part ownership of the company. That part, tiny little ownership, is what is stocks. So that ownership is represented by stocks in that company. Second are bonds. Bonds are nothing but debt instruments that basically pay you an interest and then return your principal amount at the maturity. There are very different kinds of bonds. There are treasury bonds. Treasury bonds are bonds that are issued by the country. But then there are also company bonds. Company bonds are bonds issued by the company. The company says, I need $100 million. Where am I going to get that money? Now, what they feel is that I don't want to dilute my equity. Equity is what stocks are related to, right? So they don't want to dilute the equity, but still they want to raise some money. That's when they do it with bonds. So they'll give out bonds and then pay you an interest and return your principal at maturity. Bonds are mostly issued by companies when they try to focus in on say a project, right? Say Elon Musk at Tesla, he wants to build one more Tesla factory in China. He doesn't have that money
Can you
to.
get on this line for Wharton Business School? Just get on your email.
Thank you. He really does not have that money to build another factory in China. So what he does is that, and he really does not want to give away stocks because he wants to own them, right? He wants to be the owner of Tesla. He wants to be a majority share owner, right? So what he does is he will issue bonds, collect that money from you, and at the end of like say 7 years or 10 years, return you an interest and your principal, because by that time he has had put that factory into China and made say a lot more, right? That's why bonds is another asset class that you might look at. Third is real estate. As you might have been seeing your parents, they focus on buying a home, right? They say that, you know what, I'm going to have a summer home and I'm going to have a winter home. Well, that's another way of investing, because at the end of the day, real estate values are also compounding year on year. So, for example, I'm based out of Philadelphia. So, say a house that I could get in Philadelphia for $350,000 in 2014 is not the same house that I can get for $350,000 in 2024. Now, that value has gone up to, say, $500,000, right? So that's also an investment that you can focus on. You say that, hey, you know what? I'm going to buy a house, or I'm going to buy a warehouse. You know, I'm gonna establish a logistics business, so I'm going to buy a warehouse. By the time you walk out of the warehouse, the value of that warehouse has now grown. So that's also an asset class that you can invest in. The next one is commodities like raw materials or primary products like agricultural products or energy resources, right? Like, for example, we could say, I will build a windmill, and the electricity that I generate from that windmill, I'm going to sell it out as electricity, and I'm going to take that money. So that's another asset class that we can focus on. And then it's cash and cash equivalents. You always want to be cash rich. At no point do you want to have a liquidity crisis at your hands, right? And that's why you'll always keep cash, and which is another asset class. But for this workshop, and I think for Jim too, and also in your lives, I think we will mostly focus on stocks and bonds and maybe some parts of real estate. We will also focus on different kinds of funds that are out there where you can invest your money. We'll also focus a little bit on cryptocurrency, which is coming up. It's a deregulated DeFi business, which you can definitely invest in. It's volatile, but it's making pretty good money, right? And lastly, we'd also look at some of these ESG funds, which I feel like Wharton is big on, and we strongly feel is something that your generation should definitely look at, because you guys have another 70, 80 years to go, right? You don't want to invest in a business that's gonna, make some crazy climate change, or make some crazy, governance issues. You want to invest in business which adhere to uh, ESG, environmental, social, and governance policies that you believe in, right? So you see all that later on. Some amount of it today, most of it over the next seven workshops. So one of the things that I felt that one of the things that you should know going into the gym and in your personal lives is diversification. It's a huge thing. You don't want to hold a basket of the same kind of stocks, because think of it. You say, I like tech. I want to buy as many tech stocks as I want. And then come 2021, 2022, and tech plunges right across. And now all the, say, $1,000 that you have invested or $5,000 you've invested is now $0. And you don't want to do that, right? You want to protect your money. You want to make your money work. You want to build something on top of it and not go down to zero. And that is something that you really want, right? So diversification is very important. Another example, think about it. You feel like I want to buy crazy amount of real estates. I want to buy a house in Miami. I want to buy a house at Lake Tahoe. I want to buy a house in New York, in Manhattan. And suddenly it's 2009, 2010, and we have the real estate crisis. And then the value of your houses are close to zero, or you're on the risk of foreclosure. Do you want that? Do you want your houses to go away, the ones that you've thought so much on, invested so much in? Definitely not, right? So one of the key things about the finance world, about investing, is diversification in financial markets and asset classes. When I say diversification in financial markets, I mean that you don't want to be invested in only one market. You say you want to invest some of it in the New York Stock Exchange. You want to invest some of it in the London Stock Exchange. You want to invest some of it in the Hong Kong Stock Exchange. You want to be as diverse as you can, because that's the key to not only maintain your money at the levels it is, but also grow them and reduce your risk. By spreading the investments across all these different financial markets and different asset classes, the risk of loss is quite reduced, and your losses in one market or your losses in one asset class might be offset by the gains in another market and the gains in another asset class. And it ultimately gives you a potential for much higher returns than you can have if you just focus on one market or one asset class. The third point why you want to do this, why you want to diversify, is stability. When you have a diversified portfolio, it tends to be much more stable. Like I said, if you've invested, say, $5,000, there's very low chance, there is very low risk that your money is gonna go lower than $5,000. It will go up or it will stay at 5,000, but very low chance that it will go lower. And that's why you need that stability in your investments, in your portfolio. And lastly, it should be inflation protection. I'm not sure how much you have been following the news, but the Fed rates came out just today, the US Fed rates. And if you have been following the news a bit, you'll be seeing that they did not change the rates today. And the US Fed sees that they will change the rates maybe once this year and around 3 to 4 times next year. So this is because the inflation, they want to tame inflation. They want to bring inflation down to 2%. But if you have only one asset class, say whether it's stocks or say real estate, inflation might eat into your profits, because a higher inflation means that your profits are getting down, right? Inflation adjusted, mostly in commodities and real estate, right? So if you are diversifying your investments across financial markets and asset classes, you're basically protecting yourself against inflation. So let's start with bonds. Like I said, bonds is nothing but a debt instrument, which is basically nothing but a loan that an investor gives to a borrower. And then the borrower says, okay, at the end of, say, 7 years, 10 years, 15 years, or when is the bond's maturity date, they're going to give you back your principal money, which is basically nothing but the amount you invested, along with the interest amount that you accumulated on that bond, basically the interest amount that you accumulated through those 7, 10, 15 years. Now, what are the type of bonds that are out there? Definitely, number one is government bonds, right? Like, say, for example, these are bonds that are issued by national governments, and these are the bonds that have the lowest risk rate, because quick question. Does anyone here think that that the US government might not be able to return your money? Of course not. Nobody thinks that, because that's like, if someday the US government is not being able to return you your money, that's a doomsday event. So government bonds are the most sophisticated kind of bonds, very risk-free kind of bonds, but they also give you the lowest amount of interest rates. So you have to understand, and that's why, again, diversify onto like what are the different kinds of bonds you want to buy, so that some bonds will have really good returns, but they will be as risky as it can get, which is basically nothing but the last point, the high yield bonds, the junk bonds, which are bonds basically issued by companies which have very low credit ratings, which are like, say, on the verge of a bankruptcy. And they would be like, we need this money to survive. And we are going to give you a really high interest rate. We are going to give you like something like 15-20% year-on-year interest rate. Because if we survive and if we make money, you are going to make a lot of money. But say there's a percentage of risk in that. Like, say, for example, there's a 70-75% chance that it don't survive, that the company won't survive and the company would go under. And once that happens, your money is gone forever, right? And that's why those bonds will give you the highest amount of interest rates. Coming back to after government bonds, corporate bonds. Corporate bonds are basically issued by private companies. They want to raise some capital. Basically, they do that to finance some project, something or the other. Like, for example, Amazon. Amazon issued a lot of bonds when they wanted to, buy or rent warehouses where they kind of sort the materials and then send it out to your houses, right? So instead of like using money that they have or using money from their balance sheet, what they do is they'll issue corporate bonds, take money from you, and then use it to grow their business, and then give you back your principal and your interest, whatever is accumulated. Then there are municipal bonds, which are issued by state and local governments, like, for example, the state of Pennsylvania, the government of Pennsylvania, the government of Texas can issue bonds because they want to raise money to, say, do something. They want to build something. Say they want to build a bridge. For lack of better example, say the government of Maryland and Baltimore wants to build the Baltimore Bridge again, and they issue municipal bonds. They take your money, build that bridge, and then return you back, say, after 5 years or 7 years or 10 years, whatever is the timeline of that bond. And then we have agency bonds, which are like government-sponsored entities that fund specific activities, like, for example, Customs. U.S. Customs issues bonds. Sometimes they say that we want to hire more people because we are understaffed and now we don't have that money. So they will kind of, just give out bonds and hire more people, and then kind of return you your money after a certain timeline, after a certain period of time. So when we think about bonds, we also need to think about what are the benefits and the risks, right? The benefit is definitely fixed income, because when you're buying a bond, you know that you'll get a return unless you're buying those high yield junk bonds, right? then you're on your own. Then Anomitra can't help you. But if you're buying a government bond, but if you're buying a corporate bond, you know that you're going to get your money back, and might be you also get periodic interest payments. So you have a fixed income coming to you every 3 months or 6 months or every year. The second benefit would be capital preservation, which is basically like you put in $5,000 in one of the non-risky bonds. You know that even if everything goes sour, you'd still get your $5,000 back. And lastly would be diversification, including bonds in your portfolio. They will reduce your risks by offsetting the volatility of other asset classes. Say, for lack of better examples, crypto. Crypto is really high at this point of time, but if anyone has been following the crypto rates, they're really down in 2021 and 2022, right? So it's a volatile asset class. So to offset that volatility, you want to buy some government bonds, which is really, really risk-free and really less volatile. The risks of bonds would be definitely interest rate risks, because bond prices would move inversely to interest rates, right? So interest rates go up, the interest rates on the bonds would go down, which is happening right now because over the last 1 or 2 years, the interest rates have gone up, which have caused the bond prices to fall. And as we can see, the 10-year rates are inverted, which is kind of causing all of this problems that's going on in this world right now. There's credit risk, there's inflation risk, and there's reinvestment risk. Now, the credit risk is that the issuer may default, like say junk bonds, right? There's very high chance that they might not be able to, they might not be able to give you back your money. So there's a credit risk. And then there's inflation risk, because say you have your money coming in at a 5% interest rate, and say the inflation is around 2-3%. So if you adjust inflation to how much you're getting back, because you're paying more for everything else, you're paying more for the vegetables you're buying, you're paying more for the rent of your house, you're paying more for the education that you're getting. So the actual profit that you're making from the bonds is much less when you adjust it to inflation. But what are the factors that you can consider while investing in bonds? What are the things that you look at? So now going back to when you are when you're in the gym, and you see that you want to invest in a few bonds. What are the things that you look at? You look at the credit ratings. What's the credit worthiness of the bond issuer? Like, what's the credit worthiness of a Tesla? Why should I give my money to Elon Musk? Higher credit ratings generally will indicate a lower risk. Like, say, for example, say companies who have never defaulted, they will be AAA rated, which are like really great companies. You know that they will be, can you please go on mute? Thank you. So you'll see that these are folks who have always returned their money. And so you will be able to kind of know that your money is in safe hands. Second is look at the interest rates. Do these interest rates align with your goals? Do these interest rates align with the goals that you have in your mind for yourself? Like, I want to make $200 for every $5,000 that I invest. Do the interest rates support that or not? You've got to look at the interest rates to figure that out. The third, the maturity, the length of time. Say you have, in the gym or in your real life, and let's talk about your lives. Say you want to do an MBA, say 10 years down the line. You guys are somewhere around 17, 18 right now. Around 28, you want to go for an MBA. So there you have a 10-year horizon, and you want to make, like, say, $150,000, $160,000 or $200,000 to pay for your MBA. So you have to look at the maturity of those bonds. So you cannot take a bond which matures in like 20 years, because then it's not serving your purpose. It's not serving your goals. Longer maturity bonds are generally more sensitive to interest rate changes. So you'd also want to invest in lower bonds, like 5-year bonds. You generally don't change much with interest rates. You'd look at the yield, and then you'd look at the callability. Some bonds may have a call provision, which allows the issuer to redeem the bonds before maturity, which means that you'll get less money on your bonds, right? So again, coming back, $100 in a year, you should get at a 5% interest rate, you should get $105, right? Now think about it. What if the callability says that they can call back in 6 months, and they feel that, oh, we have the money to give you back. So now for that $100, you get $2.5, right? So you should look at these things before you decide on which bonds to buy, or what kind of bonds you want to invest in. The next would be stocks. I think the most, I would say, really, really interesting stuff, right? Stocks. So when you start looking at stocks, you have to understand there are two kinds of stocks. One is common stocks, the other are preferred stocks. Now, preferred stocks are basically nothing but a hybrid between common stocks and bonds. They provide dividends at a fixed rate, but then have a higher claim on assets and earnings than common stockholders. A few companies, to retain ownership, the owners take more preferred stocks because it gives them more, they have more dividend income. They have a higher claim on the assets and earnings of that company than common stockholders. But what are the benefits and risks of investing in stocks, right? The benefits would be definitely capital appreciation. You'd get dividends. Many companies, actually almost most companies, will pay you dividends every year. So that's an income that you'll have. You'll have ownership and voting rights. So basically you will be like, you can vote on who gets to run the company. You can vote on what assets the company buys. You get to decide how the company is run because you have provided the money to them to run the company. And then there's a potential for long-term growth. Like, for example, say to 2000s, the Nasdaq or the S&P 500 of 2000s was a much lower value than the S&P 500s and Nasdaqs of today, right? A much higher value. So the long-term growth prospects of stocks or the index as a whole is much better and much more suited and much bigger. But there are definitely risks, right? Like, for example, there will be definitely market risks. Stocks are volatile. They'll fluctuate. Say something, say a government wants Amazon to get out of their country. The Amazon stocks are going to go down overnight, right? It's a risk because they are not going to be able to make as much money because they're exiting one country, right? But they made a lot of business. So there's market risk, there's a business risk, there's so many different, a company's financial performance can be affected by so many things, regulatory challenges, by different competitions, and it's going to impact the stock prices to a very, very huge extent. There will be liquidity risks. Some stocks may be very thinly traded, making it very difficult to buy or sell at a price you want. And then there's the potential for loss, right? Like, say, for example, you want to buy NVIDIA right now. NVIDIA is trading at around, I think, $300, $320, $330. And say the world is moving away from AI in the next, say, 5 years. Can happen. It's a once in a lifetime event. Can happen. They want to move away. So the NVIDIA stock can no longer be at a 320, 330 level. So there's going to dip. Now you have come in, you have bought those stocks at $320, right? And it's going to go down. So there's a very good big potential that you might lose money when you invest in stocks. And you need to be okay with that. And that's why, again, diversification. You don't want to be only invested in stocks. You want to be invested in bonds, real estate, and cryptocurrency, and all of that. Sorry, I think this is factors to consider while investing in stocks. Number one of the things that I've learned at Wharton, and I cannot stress enough on this, and I think it's one of the most phenomenal things that my professor told me. Ultimately, stocks are nothing but part of a company, and a company is nothing but a business. So understand the company fundamentals, understand what business they are in, understand who are the people that's running those companies, because that's what's gonna give you the confidence on whether you want to buy that stock or not. Companies at the end of the day are businesses run by individuals. So try to understand those fundamentals, try to understand the company, try to understand the industry before you go ahead and think about whether you want to buy a stock or not. The third thing you want to consider is definitely valuation metrics. Some companies will be much more overvalued than they are, and then some companies will be much more undervalued than they are. You want to find those undervalued companies because that's where value creation is begging to happen, and that's where money can be made. Those which are overvalued company, people will someday figure out that they are overvalued, and then they're going to exit from those companies and the price is going to come crashing down. You don't want to get in there. You want to find those undervalued companies. You want to find NVIDIA before the AI boom. You want to find NVIDIA in 2022 so that you can ride the stock into 2024. That's what you need to do. That's what you want to do. Thus, valuation is a very important part. You should look at price to earnings ratio, price to book ratio, and evaluate if the stock is undervalued or overvalued. Lastly, diversification. Don't go for one single industry. Go for multiple industries. Don't go for one single company. Go for multiple companies. And lastly, look at your investment horizon. What's the number of years you want to play it with? 5 years, 2 years, 2 months, 2 hours. You want to be a trader. You want to buy right now, sell in 2 hours. Think about your investment horizon and then take a call. The third thing is mutual funds. Now there are different kinds of funds out there, right? Which basically you can be a passive investor in, and even in your gyms, in your gym, you might. I think you are geared to invest in one of the funds, ESG or equity funds or fixed income funds. So there are different types of mutual funds available, like equity funds, which primarily invests in stocks. Then there are fixed income funds, which invest in bonds and other debt instruments. Then there are ESG funds, which will invest in only companies which are which follow the ESG strategies and do good in this world. Then there are money market funds, which kind of invest short-term, low-risk securities and offer a higher return than savings accounts. And then there are specialty funds, like funds which invest in commodities, funds that invest in currencies. Like, for example, tomorrow, just you will look at it. So say a USD versus a yuan, right? It's always changing every day. And think about the amount you can make if you're, say, investing $1 million into buying yuan today, which goes up, say, 10% tomorrow, and you sell it off. So you're totally making 10% on $1 million in a day. So basically, these are different funds that are out there. And you have to choose according to what your strategy is. How do you want to use these funds? Do you want them to be passive? Do you want them to be riskless? Do you want them to be more risky than you are? Because inherently so you have to understand who you are as a person. If you are a person who does not like to take more risks, you would want to invest in funds which take higher risks, and you yourself do investments into low risk asset classes and low risk financial metrics. What are the benefits of investing in funds? Definitely diversification. Funds have built-in diversification. They have baskets of securities that they invest in. These are money managers who have been doing it for years and years, multiple decades. So they definitely know it better than you do. So that's one thing why you'd look at funds. Second is professional management. Not everyone is built to be traders. Not everyone is built to be investors. Not everyone is built to be take a high risk investor or a low risk investor. So you also want someone to do that for you. You do want professional management. The third is liquidity. You can buy mutual fund shares any day and sell them any day. It depends on NAV. NAV is a net asset value. So basically, the amount of money that the fund manages is under NAV. So the NAV today can be lower and the NAV tomorrow can be higher. So you buy today and exit tomorrow or exit 2 months down the line, and you can still make a lot of money. So there's liquidity, which you might not get in, say, real estate. You might have to hold on to their house. People do not have money to buy a house today. So you might have to hold on to your house for, say, 2 years, 4 years, 5 years before you can actually be able to sell that house. Accessibility, very easily accessible. There are scores and scores of funds out there which you can research on and kind of like buy, and then there's regulatory oversight. So Uncle Sam is looking over these funds, so you can be rest assured that your money is in more or less safe hands. Let's keep it that way. the factors to factors to consider while you invest in mutual funds are basically investment objectives. What are the fees and expenses? Then you look at the fund's historical performance. How have they done over the last 5 years? How have they done over the last 10 years? And then think about if that aligns with your goals or not. And if it does, then that's the fund you want to invest in. You look at the fund manager and the management tenure. Again, I kind of repeat, fund managers are people. The mutual funds are being managed by people. So you got to know about those people. You got to know about who's running them. How have they fared in the past? How have they fared in the past? Are they like risk-taking people? Are they like non-risk-taking people? You understand who they are and how long they have been around, and then take a call. So it's very important that you look on the fund manager, their tenure, and the performance of the fund before you invest in these mutual funds. Then you also look at asset allocations and the risk profile before you decide on whether this fund works for you or not. And lastly, I think we have ETFs, which are basically exchange traded funds. It's a type of investment fund that tracks an underlying asset, which is nothing but a better way to say that there's a stock index. Index is basically like, say, NYSE. It's an index. Or they are kind of tracking a commodity or a basket of assets. And so you can buy ETFs in a day and also sell them on the same day. So these are like highly liquid. So depends on what your strategy is. You could do a lot of things through this. So there are stock ETFs, which track stock markets like the S&P 500, the NASDAQ 100, the Bombay Stock Exchange, the London Stock Exchange. There are bond ETFs, which track how the bonds are kind of faring, like what's the 10-year Fed rate, what's the 5-year Fed rate, what's the 2-year Fed rate. There's commodity ETFs, which are tracking the prices of gold, silver, oil, black gold, agricultural products, and kind of change it on daily. There are currency ETFs, which track a currency, like say, for example, a yuan. They might be tracking the dollar, a renminbi, an Indian rupee, and then there are alternative ETFs, which offer exposure to alternative asset classes like like private equity or hedge fund. So what are the benefits on? Can I ask everyone to please go on mute? Thank you. The benefits of investing in ETFs are diversification, low costs, tax efficiency, liquidity, and transparency. So basically nothing but you can go in and you can get out very easily. There are lower costs. They are already diverse. They sometimes have tax benefits, which you can avail. And they have to be transparent because they are exchange traded, right? So they're trading. So they have to disclose their holdings daily. So you can look at their holdings and decide whether you want to go with this ETF or not. So what are the factors that you should look at while investing in these ETFs, right? So you should look at the underlying index. You should look at the expense ratio. You should look at the liquidity, evaluate the trading volume of an ETF, to track the error. Sometimes the ETF's ability to accurately track the performance might not be so great. So track how much error there is between what they are tracking and what actually is going on in that index. And then look at tax implications if you're doing this because you want to save on some taxes somewhere else. These are some trading strategies, not much. I wanted to keep 10 minutes for Q&A, so I'll just go a little bit faster through these. There are different trading strategies that you might hold on to when you're playing in the gym or like in your real life too. There's buy and hold, which is basically you buy and forget about the stocks, which is a long-term investment strategy. Then there's an active trading. You buy right now, you sell right now, you make some money, and then you move on to the next asset class or you move on to the next trade that you want to do. Then there's technical analysis, there's fundamental analysis. We go deeper into these in the next classes, in the next workshop modules. Then there's contrarian investing. But before we go today, I wanted to talk about the risk management techniques. We have one entire workshop on risk management and how we could get the highest amount of return that we can get on the lowest amount of risk. We should be doing this on the 4th or the 5th workshop. So you could do this through stop loss orders, position sizing, again, diversification. I think you're now used to this. So many times I've said diversification. I'm sure you know that diversification is the number one rule in finance, number one rule if you are investing, and the number one rule if you want to make money. Then you also look at the risk reward ratio and the money management techniques. That's it.